One, two, three, start. Hello, friends. Welcome to another episode of Chart Mojo. In this video, we will understand about bull call spread. If you remember, in the last video, we were discussing about a reversal kind of a setup where mid cap index had fallen, had given a very steep correction, and it was near support level. We have discussed 3 to 4 stock on that day, and we were looking at making bull call spread or credit spread in those. Okay, so ideally, first we will learn about bull call spread. Okay, and to understand bull call spread, I have given here an example. So we will start looking at this option chain, and as you can see, to make a bull call spread, we need one long option. Okay, so here we have chosen a ATM strike. You can see in this option chain 1110 strike price, 1110 call option, which is at 5 rupees. We will go long on this. Okay, and we are selling one OTM option here, 120 strike call option at 2.5. So this is an sell leg. This will be a sell. So one long, one sell will make this strategy as an bull call spread. Here in this, as we are buying one long option, we are going long on delta, okay, and we are losing theta. So when we sell a strike or two strike a hit call option in our example 120, what we are doing, we are now short on delta and long on theta. So because of this, we see a payoff with limited risk and limited return. So in this particular example which we are looking at, we see a maximum of 2.5 points loss. Okay, so how this is calculated? As we are buying 1110 call option which cost us 5 points, okay, or 5 rupees, and we are selling 120 call option at 2.5. Okay, so the net amount you pay is of 2.5, because once you pay 5 rupees to long to make a long call at 1110, you simultaneously sell 2.5 rupees option, because of which your 2.5 rupees, your sold option, will offset that, and you do not need to pay anything. Now definitely this will require a margin. If you do nifty, near about 25 to 30. If you do stock option, it will depend upon the volatility in that stock per lot basis. Now for maximum gain, okay, so this comes to near about 2.5, okay, which we can lose. Now for maximum gain, we can see 1110 call option which we have bought at 5, and if this 1110 call option, okay, at the expiry, we see the current market price goes to 120, okay, at the strike which we have sold. Now 1110 call option which we have bought for 5 will go to 10 rupees. Why? Because at the expiry, if your underlying is at now 120, your 1110 call option will be definitely at 10 rupees. So your 5 rupees call option will go to 10 rupees, and you have sold 120 CE at 2.5. Okay, so this will go to 0. Okay, now how much you have earned is 5 rupees on the incremental value of 1110. Okay, here is the 5 rupees, because 5 was your cost to buy 1110 call strike, and you earn this whole 2.5 rupees, 2.5 points, which you have sold to make a bull call spread. That's how 7.5 we see the calculation here in the above calculation. It is. Now guys, a question will come in your mind is, sir, if we are bullish on the underlying. If we see a breakout, or if we want to play, if we are very confident, then can we buy a call directly? Isn't that will give us a good payoff? So answer is yes, that will give us a very good return. But as we know, breakout do fail, reversal do fail, and if we are having less conviction, or if we feel that the underlying on which we are doing speculation is not showing a very confluencing signal, okay, we are only getting out of 3 or 4 signal, we are only getting 2 signal for a long trade. That time you can deploy bull call spread. Sometimes we feel that the amount which we are paying for a long call option, okay, we want to subsidize it, or we want that premium to go down. So instead of waiting, sometimes we sell the OTM option to reduce the cost of that trade. Now definitely our maximum gain is also capped. Sometimes we feel that the after breakout discounter can only go till up to X points, or up till X percentage. So as we are very clear that there is an overhead resistance, or the stock will meet resistance at certain level, then one can buy on breakout the strike which with the breakout level, or just above the breakout level, with and sell the strike near the resistance level. That is also done. So bull call spread is basically made when, so for primarily for two reasons. Number one is when we are not very much confident about the underlying move, and second, we need to offset the cost, as we are not again very confident about the timing of the breakout. Because if we only go long on one call option, let us say 1110, we go long on one call option, then what happened is sometime uh, the price goes down after we enter the trade. That 5 rupees option will go to, let us say in our example, 3, or let us say 2 rupees. At that time your SL will get trigger. So because we were not very much confident about time breakout timing, one can simply do this setup. And in our example, in the particular case which I am discussing right now, if you would have sold 2.5 rupees option, it would have went till 1 rupees. So we would have only faced a loss of, let us say, 1 rupees, if we were going with the bull call spread, or any spread in that scenario, when we are not very much confident about the timing of the breakout. So guys, similarly, as we are looking at bull call spread, one can initiate bear put spread as well by simply doing same scenario. So in our example, let us see, if we want to deploy the same thing, if we are having a bearish view, what we do, we buy 6 rupees, we buy 1110 p at 6 rupees, and we sell. So this will be buy leg, and the sell leg will be 105 p. Okay, so net debit will be 3 rupees. So same scenario can be done on the put side as well. So now let us look at some of the example. So I have selected 3 stock, and we will see what are their payoff. Okay. So now let us go to the charts. Guys, now we will look at the examples. And here I'm looking at 3 counters: ITC, Apollo Tire, and RBL Bank. So I have selected all three counters with different volatility. We know ITC is a low beta counter. Okay, so as you can see on the chart right now, ITC is forming a base, and we can clearly see ITC is also trying to give a breakout from its falling support line. Okay. Now you see a very good support and you see a counter trying to give a breakout. But you also look at Nifty and you see from the past 3 days, Nifty is giving a correction. So right now, you know that the index is giving a fall, ITC is holding up, which means there is some strength. It is holding up near its support level. But your kind of a, your conviction is less that it would give a breakout till 360. But you are kind of a, you have come up with your conclusion that this counter can go up till 350 in this current month. So at that time, we can initiate bull call spread that we were discussing. So just we should look at the option chain here. I will go to option chain and we can see the 337.5 option is at about 4.5 rupees. Okay. So what we will do to make a bull call spread, we will go long at 4.5 and we will short as we are expecting near about 350 level. We can short 345. So we can make a bull call spread. Now one question will come to your mind is, sir, can we instead of 345, can we short 340 or can we short 342.5? This will reduce our net debit. So that is correct, but your reward will also be less in that case. Okay. So let me show you this by showing the payoff this trade. Let us quickly select ITC here and select both of those strike price. So we will go to ITC. We will add current expiry option 327.5 call option. Sorry, 337.5 call option at running at 4.5, and we will sell 345 call option against it. We get a payoff in this manner where we see we will require a near about 18,000 margin in this, and the max gain in this kind of spread can be about 8,000, could be about 8,000 rupees, and the max loss is near about 3,920, which give us a roughly 1:2 kind of a RR trade. Now if someone says instead of 345, can we short 342.5, then what would be the payoff? Definitely you will be having less risk, but your reward will also reduce. So we will go to 342.5 and we will sell this. So as you can see, your now total loss will be around 2,800. Okay, but your reward will also be less. So if you take less risk, your reward will reduce little bit there. Now here the RR is about 1:1.8. Okay, in our previous spread which we were looking in this example, we have got 1:2 RR. Now let us look at the other example. This is Apollo tire chart and we can see the counter had given a breakout from a broadening pattern, but today we could have seen follow up buying, but instead of follow up buying, we are seeing that the counter is not able to sustain at higher level, and from 340 actually it had corrected. Now as per the candlestick pattern, we call this as a dark cloud cover, and if this counter goes below 320, then we might see again a correction till 3110. Okay, now this is your view. As we can see the monthly chart here, we see a clear uptrend, a clear momentum in the counter, and because of this, if we are thinking that we could make a bull call spread as the counter have given a breakout above its previous month high, then that is also a fair point. So to make a bull call spread, we will go to option chain, and in this particular case, Look at 330 call option. One can add this call option and one can sell 340 call option. So we will look at the payoff this particular trade. We will lose near about, if we go wrong, we will lose near about 4 rupees. If we go right in that trade, we may make near about 6 or 7 rupees in that. Let me check it. So here we will simply go to Apollo tires, and the strike will be 330 call option. We'll add it, and to make a full call spread, we will sell 340 call option. This is buy. Yes. So here what you will see is, now this require little bit more margin. It is about 40k. The stock is kind of a mid volatile. Also you can see here the RR is of 1:1.5. Now you will notice that sometime you get 1:1.5 RR, sometime you will get 1.2 RR. Okay. So one question will come to your mind here is, sir, here the RR is 1:1.5. If we want to increase this RR, should we go OTM? So answer is yes, we can go to OTM, but that will reduce your probability. Okay, here the probability of winning or a trade going right is near about 41% as per the statistics. Now we will go OTM. Let's try and make this bull call spread on higher strike. So instead of 330 call option, let me select 340 call option. Okay, we'll buy this and let us sell 350 call option. So here, as you can see, your RR will increase. Okay, here we are now seeing 1:3. Okay, one time risk, 3 time reward, but we can also see the probability going down till 28%, 29%. So our probability of winning went down by 11% statistically. Now, sir, if the if the gain is on a higher side in this particular spread, then should we make always OTM spread? So you need to be aware about the market condition that you are trading. Right now there is a failure, or there is rejection and breakout level in the Apollo tires. That's why now little bit OTM, if we go, the options premium are such that it is showing a higher reward. So higher reward doesn't mean that we should always choose the OTM strike. Can we go ITM strike? So let us see what happens if we go ITM in this case. Now we know this is a broadening pattern. Okay, so let me show you the chart again. As we know, this is a broadening pattern, and if you're confident about that, somehow it will either expire near 320 or 330 level. Okay, so in that case you try to make a ITM spread. Let us go and make a ITM spread, and let us see the statistics of it. Now instead of 340C, what we will do, we'll like to long 320CE. Okay, we are going long on 320CE, and we are shorting 330, or let us go 310. Let us go 310 long, going long on 310. You're shorting 325, which you feel that this can go sideways or expire in that zone. So in this case, our probability goes up. See this here, the probability of winning is 63%, but now you will see that your RR is, you are losing one time but you are gaining only 0.5. Okay, So this kind of a trade is again not very good. Why? Because in this particular case, if you're losing one time, at least we need to win one time, okay, with 50% and above probability. So this kind of inside, okay, making a bull call spread inside, okay, in the money option is not advisable. Okay, now let us see the last counter which we were looking at. Okay, we will go to RBL Bank or RBL Bank iBull Housing. Okay, these are quite high beta counters, and we can see the counter is in good uptrend. Okay, so when the counter is in good uptrend, the bias is of upside. Definitely we will get call option with a slight higher premium than the put option. Okay, now because market is in a correction mode, we might see put option also gaining some value. Because the counter is in one way uptrend, we may find this kind of a disparity. Let us go to option chain and try to make one OTM full call spread here, or ATM. We will select the ATM strike. Okay, ATM 185, we will select the 185 strike. Stock is at 184. Let us go and let us buy RBL Bank 185 call option. We will add a position and we will sell near about, we may feel 200 is the strike price where it will hit resistance. So 195, which is about 4 rupees. So when this counter will expire near about at 200 rupees, still only 1 rupees will be lost in this. We'll sell this particular strike. Now, as the counter is in one way upside trend, we see that the call side premium are little bit expensive, because of which we may find in this particular case that your RR 1 is to 1.7 that we are getting, okay, is due to most of the other participants are also expecting a upside movement and that is seen in the behavior of a call, you can see a bull call side, okay, in a bull call spread. So guys, we have taken 3 example. One is of low volatile counter, one is of mid, and one is of quite high volatility. And we have seen bull call spread in this. If we go ITM, we find that our probability of winning goes up, but RR, if we see, we are losing one time, so we are only getting 0.5. That's a very bad sign. So we see OTM, ATM long option, okay, long call, and OTM short, or OTM long call with OTM short. Okay, so that is the ideal way you can go for in this particular full call spread strategy. In the next video, we will discuss about the credit spread. And in the credit spread, we will see how the payoff graph changes and how we can manage the risk if the counter goes above our level. So guys, this is it for the video. If you like our content, hit the like button. And if you are new to the channel, please subscribe our channel. We will meet in the next episode. Bye guys.